Hello, friends! Many of you are familiar with the investor Ray Dalio, a true master in the realms of economics and investments, whose advice is trusted by millions of investors worldwide. Moreover, his expertise is sought after by the world's largest financial organizations for counsel on managing their finances. This trust is well-founded, as the hedge fund Bridgewater Associates, founded by Dalio in 1975, stands as the world's largest, with assets under management worth $150 billion. Despite stepping down as the investment chief last year, Dalio's continued presence on Bridgewater's board ensures his insights and forecasts remain highly relevant in the financial world. What truly captivates attention beyond Ray Dalio's spoken words are the deliberate actions he undertakes. These moves offer a crystal-clear window into his prognostications for the future trajectory of financial markets and provide a blueprint for how investors should gear up for what's coming. Currently, we find ourselves navigating through the 12.5th economic cycle, a concept that might seem esoteric to some but has profound implications for understanding global financial trends. This cycle concept, which has seen 12.5 iterations since the pivotal year of 1945, a year that heralded a new global order and the inception of a revamped monetary system, serves as a historical compass guiding us through the ebbs and flows of economic fortunes and misfortunes. Understanding these cycles is paramount as they encapsulate the rhythmic dance of economic expansion and contraction, of booms and busts. Dalio's actions, therefore, are not random or isolated. They are deeply informed by his reading of these cycles, his anticipation of future market movements, and his strategic positioning to not just weather potential storms, but to emerge from them positioned for greater success. This awareness of and preparation for the cycle's implications are critical for individual investors and the broader financial community as we steer through the complexities of modern economies, making Dalio's approach a subject of keen interest and study for anyone keen on navigating the future of investments with acumen. Let me briefly take you through recent events. The economy was booming until 2020 when COVID-19 struck hard, leading to a wealth redistribution process. The government had to issue numerous checks, funded by borrowing from the Federal Reserve, creating a significant imbalance. This influx of money into the system is a classic cycle. Initial monetary stimulation turns into debt, followed by a period of high inflation, which then leads to stringent monetary policies. Where do we currently find ourselves in the economic cycle? We're at a pivotal juncture, witnessing a dramatic shift where interest rates, which were hovering near the zero mark for an extended period, have now skyrocketed. This surge has propelled us into a scenario where the cost of borrowing is significantly higher than we've been accustomed to in recent years. In the past, during periods of low interest rates, holding cash was often likened to holding onto something worthless. It was derisively labeled as trash due to its inability to generate returns in a low-rate environment. However, as the economic landscape evolves and interest rates climb, the value proposition of holding cash has undergone a remarkable transformation. Ray Dalio, a seasoned investor whose insights have guided many through the complexities of the market, has highlighted this significant shift. He points out that cash, previously scorned during times of cheap money, has now emerged as a phoenix rising from the ashes. This renaissance of cash as a desirable asset is a direct consequence of the changing economic conditions. Higher interest rates make earning interest on cash and cash equivalents more feasible, thus making them an attractive component of a diversified investment strategy. Dalio's observations underscore a broader economic principle: the importance of adaptability and the recognition that the value of different assets can fluctuate dramatically based on broader monetary policies and economic trends. This insight into the renewed appeal of cash in a high-interest rate environment is a crucial lesson for investors navigating the current economic climate. Ray Dalio's recent pivot in his perspective on cash represents a profound lesson in financial adaptability and foresight. Historically, Dalio regarded cash as an unfavorable investment, especially during times of inflation when its purchasing power diminishes rapidly. However, his updated view, amidst an environment of skyrocketing interest rates and economic uncertainty, underscores cash as not just a safety net, but a strategic asset. This change is a testament to the principle of flexibility in investment philosophy, echoing the wisdom of John Maynard Keynes. When the facts change, I change my mind. Such adaptability is crucial in navigating the volatile currents of global finance. Dalio's reassessment signals a broader recognition of cash's value in buffering against market unpredictability and providing liquidity when opportunities arise. In an era where economic indicators and central bank policies can shift dramatically, the ability to pivot based on evolving data is invaluable. Dalio's shift is not merely a change in investment strategy, it's a reflection on the importance of staying agile and responsive to the global economic landscape's fluid nature. This approach not only safeguards assets but also positions investors to capitalize on potential market corrections or downturns, illustrating a sophisticated understanding of the intricate dance between risk and opportunity in the financial markets. Looking beyond Dalio's words to his actions reveals even more. Analyzing the top 50 positions in his portfolio shows significant sales and reductions in his holdings, with reductions in 44 assets out of the 150 that make up the largest portion of his portfolio. This level of portfolio downsizing is unprecedented for Dalio, with the combined value of these assets running into billions of dollars. Such a strategy suggests a deliberate move to increase cash reserves, potentially in anticipation of future market downturns. This approach is not isolated. Many professional investors have expressed concerns about impending economic challenges. Dalio's recent actions, including changing his stance on cash, aggressively selling off stocks, and Bridgewater's plan to lay off about 8% of its workforce, mirror broader industry trends amid economic instability. These moves by smart money investors like Dalio and Bridgewater, who typically have a keen sense of market direction, suggest a cautious stance towards current market conditions. From Dalio's perspective, the current economic environment does not bode well for immediate positive changes. His actions and words reinforce this view, emphasizing the value of cash in uncertain times and suggesting a strategy of waiting for more favorable investment opportunities. This cautious approach, selling off assets to increase cash reserves, reflects a broader sentiment among seasoned investors about the future of the economy and financial markets. In conclusion, Ray Dalio's insights and actions offer a valuable lesson in financial prudence and the importance of adapting strategies to changing economic landscapes. As we navigate these uncertain times, it's worth considering whether to follow Dalio's lead by being cautious and possibly increasing our cash reserves, or if we see opportunities worth pursuing now. I invite you to share your thoughts and strategies in the comments below. Thank you for watching, and I wish you all the best and most positive investment experiences. See you next time.